Saudi Arabian oil company and Petroleum National Berhad have made their $7 billion partnership official. Today, the two parties signed a sales purchase agreement that would allow Saudi Aramco to have equity participation in Petronas' RAPID project down south in Pengerang, Johor. On completion of the transaction, both Petronas and Saudi Aramco would hold equal ownership in selected ventures and assets of the RAPID project. Saudi Aramco's role will be to supply up to 70% of the crude feedstock requirements of the refinery, while Petronas supplies the natural gas, power and utilities. According to Petronas Group CEO Datuk Wan Zulkifli Wan Arifin, the signing of this agreement is historic, explaining that it is not often that two professionally run national oil companies enter into a partnership in a world-scale greenfield project. This also added speculation that Saudi Aramco had doubts over the project, with CEO Amin H. Nasser saying that it had no intention to break out of negotiations. Nasser was emphatic in saying that this is Saudi Aramco's final investment decision on RAPID and that it has always wanted to be in Malaysia. The first phase of RAPID is due for completion in mid-2019. CIMB Group Holdings Berhad saw a slight uptick in its net profit for the fourth quarter of FY16 due to improved net interest income. Net profit for the quarter came in at 854.4 million compared to 825.7 million last year, while similarly, revenue rose by 6.7% to 4.31 billion compared to 4.04 billion the year before. The group declared an interim dividend of 12 cents per share for the quarter, bringing its full-year payout to 20 cents per share. For its full-year report card, net profit for FY16 was up almost 25% to 3.56 billion, while revenue came in 4.4% higher at 16.07 billion compared to 15.4 billion last year. Consumer was the group's best-performing segment, with Thailand posting its first annual profit since acquisition. For the year ahead, CIMB Group CEO Tengku Datuk Sri Zafrul Aziz says that the group's focus will be on implementing its T18 strategy, explaining that the bank will continue to instill cost discipline across all businesses to achieve its T18 CIR of 50% by end 2018. Felda Global Ventures Holdings Berhad, or FGV, saw its fourth quarter earnings take a 21% hit as a result of significantly higher taxes. Net profit for the quarter registered at 110.6 million compared to 140.7 million the year before. But in contrast, revenue rose by 25% to 5.2 billion compared to 4.15 billion last year. It was a similar story on the full-year basis, with net profit falling by 84% to 29.6 million, which was no surprise given a couple of weaker earlier quarters, while revenue bumped up by 11% to 17.28 billion compared to 15.56 billion last year. For the year ahead, FGV Group President and CEO Datuk Zakaria Arshad says he is optimistic, given several improvement initiatives that have been put in place. Interestingly, Arshad said that M&As are not the group's priority following the termination agreement with Eagle High Plantations in December, adding that FGV is expecting the palm plantation business to fully recover from the impact of El Nino and an increase in planted areas coming into maturity. Malaysia Airports Holdings Berhad ended its 2016 financial year on a strong note as its Malaysian ops recorded higher income. From a net loss of 39.8 million in 2015, MAHB posted a net profit of 33.3 million for the fourth quarter of FY16, while revenue rose slightly to 1.08 billion compared to 1.04 billion the year before. On the back of those numbers, MAHB declared a final single-tier dividend of 6 cents per share. According to MAHB, the improvement was driven by higher charges as the result of more passengers and consolidation of ops at KK International Airport, among others. It was a similar story for MAHB's full-year numbers, as net profit jumped by 72% to 70.4 million, and revenue rose by 7.8% to 4.17 billion from 3.87 billion in 2015. In the coming months, MAHB is expecting passenger traffic to grow by 6.5% in 2017, a forecast that it said was based on economic conditions and airlines' confidence. Nestle and Berhad ended its 2016 financial year on a softer fourth quarter, with net profit declining by 33% with the price of commodities going up as the ringgit went down. Net profit clocked in at 66.9 million compared to 99.8 million last year. In contrast, revenue went up by 4.2% to 1.25 billion, which helped to mitigate some of the earlier weaknesses, as did Nestle's improved internal efficiencies. According to Nestle, the lower profit was also due in part to a planned and exceptionally higher marketing and trade investments in preparation for the early Chinese New Year. The company also announced a final dividend of RM1.30. The numbers were better on a full-year basis, with net profit coming in 7.9% higher at around 637 million, as revenue topped 5 billion for the first time. For the year ahead, Nestle says that given its cautiously optimistic outlook for the economy, it will continue with its Fuel the Growth strategy, which stresses on efficiency optimization and innovation.